Growth stocks have been plummeting down. I'm sure by now, many of the companies in your portfolio that you've been watching, you've noticed have been going lower and lower. You might be wondering, why are growth stocks crashing? Why does the cryptocurrency market suddenly look like it's caught on fire? You might be wondering, what's happening to the market? What's contributing to this? And then more importantly, where do things head from here? Today, we're going to unpack these questions. We'll talk about what's caused this recent growth stocks crash. We'll talk about the surrounding macroeconomic backdrop. We'll try and isolate some of those contributing factors and then more importantly, discuss what it could mean for you and your portfolio moving forward. If you do enjoy this video, don't forget to hit the like button. Feel free to share it out as well. If you're new here, welcome. We make daily videos each and every day. So if you haven't yet, make sure you've subscribed, turn your bell notifications on. It means you'll be updated every time we drop a new daily video, and we'd love to have you join the community. So I guess the question is, why are growth stocks crashing? We know there's been a range of different contributing macroeconomic narratives in the backdrop over this past period. Has it been Jerome Powell and the Federal Reserve who have really been playing a leading role over this past period out of the lockdowns and the pandemic recovery? Is it the virus? We know Omicron has really sent a scare and spooked markets. Maybe it's supply chains, which of course have contributed into rising inflation. You might be wondering, what is it? Can we distill it down to just one thing? And I think the answer is probably a little bit more simple than many people would give it credit for. Valuations. We know that over this past period, valuations have been in the discussion. There's been a lot of talk about how valuations are running high. They continue to expand over time. We know that the multiples that investors are willing to pay have continued to expand. And the question has been, how long can this go on for? And really, what are the contributing factors to it? You can see here from this little visual, over the long run average, the S&P 500 price to earnings ratio is now trading above 2 standard deviations away from the mean. Of course, we know that these high levels are unsustainable over a longer run. So the question is, what's been contributing to these high valuations? And what does it really mean for the way that we perceive the companies at the growthier end of the market? I'd love to know your thoughts on it all as well. So drop in a comment below what you've thought about this past period on markets, how you're positioning the portfolio and what you're looking out for. And then most importantly, where do you think the markets head from here after it all? And so let's talk valuations. I think first and foremost, what's most important is really delineating value, the inherent or intrinsic value of an asset, and then price, which of course is the price that individuals are willing to pay for said asset. Higher valuations and expanded multiples can be supported by a range of different factors. First and foremost is low interest rates. I'm sure many of you have heard the quote that interest rates act like gravity in the financial markets, which was first attributed to Warren Buffett. But over this past period, we've heard that there's record low interest rates being very accommodative. And we know that there's been an even more accommodative backdrop as well, supported by almost unlimited monetary policy support led by the Federal Reserve, but central banks around the world. We know there's been an expansive quantitative easing program coordinated globally. Fiscal stimulus, it seems like that fiscal stimulus tap has been continuing on, and we know that household savings rates were very high over this past period. All this excess liquidity eventually finds its ways into a range of different asset types. We know that there's been increases in housing valuations, and of course, not only in the stock market, but other types of asset types as well have seen growth in them because of this high liquidity throughout the system. And then another factor as well is the lack of alternative options. You might have heard of the TINA thesis throughout the past year. There is no alternative. With record low rates, investors are searching for yield. And as a result of that, they end up at more risky ends of the market, such as the stock market, or looking for yield in areas where there may not have been a lot of growth. We know that 2020 was a low growth environment, and so investors were really clambering over themselves to find growthy names and seek for growth in a low growth world. And that's really what led to a lot of these names being bid up over this past period. However, these times can't last forever. These have been emergency crisis type support. These levers are slowly being withdrawn, and we'll talk about how later on in the video. And we know that many of these companies in this end of the market have been priced to perfection. They've been richly or even exuberantly priced, depending on who you're asking. And slowly we're starting to see these multiples contract. And so you might be wondering, why do interest rates matter? Well, first and foremost, it's for valuation. I'm sure by now you've heard the discussion about lower long-term interest rates facilitating lower discount rates, which obviously consequently flow through to improve the long duration cash flows. The longer duration future cash flows are worth more in the present time, and ultimately that flows through to the valuations as well. But on the other side as well, it's worth noting that there's a benefit from funding too for lower interest rates. Interest rate rises, increases the cost of capital, which makes it more expensive and increases the cost of growth, particularly at the growthier end of the market where cash is not abundant yet. Of course, these companies may be still loss-making at the moment. They may only just be starting to move into profitability. As a result of that, they have to find alternative ways to source and fund their growth. And so with lower interest rates, they're able to source and fund this more easily, but rising interest rates increases that cost of capital. And so as we discussed, the growth names are the most at risk. It is worth noting and really reflecting on the fact that valuations have been elevated for a long period of time. For an extended period, investors were willing to pay whatever cost for these growthier names, and the multiples continued to be bid higher and higher and higher as these multiples expanded. I guess just really bring it back to the basics. If we think about how DCFs are run and how valuations are really constructed, obviously you're forecasting out future cash flows for a company. Then you're discounting them back to the present value and then utilizing that to get an inherent value that you're willing to pay for these companies. On the back of that, the discount rate is very, very important because a lower discount rate will mean that future cash flows are worth more in the present day, which will obviously mean that investors are willing to pay more for this company. But as the risk-free rate, as interest rates start to rise up as well, then of course the discount rates that are used for these valuations will start to rise. And ultimately that may mean we'll start to see a multiple contraction and investors are willing to pay less for these types of companies. And obviously this is all coupled in with the fact that there is an economic recovery. Other sectors and other industries within the market are starting to see more normalized trading conditions after the pandemics and the lockdowns. So that TINA alternative, the thesis that there is no real alternative, there's nowhere to look for growth, is being challenged day by day. So as we've mentioned, there's a few different sectors of companies or cohorts of companies that are probably the most exposed. Firstly, loss-making companies with high debt levels. Obviously, they need to be able to fund their growth. In a record low rate environment, they can fund it quite easily. As rates start to rise, that becomes more hard over time and they have to have an increased debt obligation to be able to pay back these debts. Companies with significant future cash flows priced in, as we've talked about, those future cash flows are going to be worth less in the present day if interest rates and the discount rate utilized rise. And then that more speculative end of the market. We saw crypto come hard down over this past weekend. So many of these more speculative names really have some rolling corrections over these past few months. So it'll be interesting to see how that evolves out. And I'd love to know your thoughts. So drop in a comment below how you've seen this play out so far in your portfolio, how you're positioning, and what you think it means for the broader market over this next period too. And so you might be wondering, why now? Many of these different factors have been playing out for the past few months. It's not as if we've only just realized that rates may eventually rise. It's not as if we've realized that rising interest rates are going to affect valuations. All of this has been known knowledge. But like anything on the markets, there is an initial catalyst, and often this then starts to feed into the broader narrative. We know that the Omicron variant spiking up initially did spook the markets. And then Jerome Powell, the Fed chair, who was renominated, then came out previously over the past week and stated that they may need to speed the taper. And that was coupled with a discussion about retiring the use of the word transitory and really recognizing that, hey, inflation may be more persistent than initially thought. Obviously, we know they have $120 billion of monthly bonds to be walked back. They were aiming to walk them back by $15 billion per month. And so that would end around about the middle of 2022. And then after that, obviously, they would potentially start to consider rising rates. But if they have to speed the taper, the market's now wondering if this means that rate rises are going to come earlier and maybe harder and faster than was initially thought. And this is what's really got the market thinking and a little bit scared. We've seen investors and funds are starting to unwind positions in the growthier names of the market and starting to position as well for the next phase of the cycle into those other sectors. What's going to be fascinating is that over this past period, really, as long as we can remember, the buy the dip mentality has been rewarded. And this has really been on the back of the fact that the market has believed, don't fight the Fed. The Federal Reserve has got the markets back and they're not going to allow it to fail. But now the buy the dip resolve will really be tested. And the market is moving from an ultra accommodative setting to potentially a sell first and ask questions later type environment. We've seen volatility spiking. Volatility is likely to continue to be an embedded part of the market over this next period till it can digest what's happening, and then we'll see where things head. And so I guess the key question is what to consider. Firstly, if you've enjoyed this video, you should consider hitting that like button. Feel free to share it out as well. If you're new here, welcome. We make daily videos each and every day. We'd love to have you join the community, so if you haven't yet, make sure you've subscribed. Turn your bell notifications on as well. You'll be updated every time we drop a new video. I think there's a few different factors to consider. First and foremost, the markets don't move up in a straight linear line. over this past period, you might have been mistaken for thinking maybe they do. It's almost felt like one-way traffic with very few retracements or pullbacks. The market does need time to breathe, and we know that markets move up, they move down, they go left, they go right, but that every type of movement is a natural part of market fluctuations. And we've got to remember everything in context. As we talk about, when in doubt, zoom out. We're coming off a phenomenal past period for many of these growth stocks. I know it seems like there's been a bit of a pullback, but if we just have a look at the chart here on the right, this is the Nasdaq just coming out of the lows of the pandemic in 2020 from that March-April period. The Nasdaq has risen by over 100% since that past period. Many of these growthier names have seen phenomenal periods of growth that were unparalleled and really can't be expected to be replicated. So we've got to remember that in context. The market does move in cycles, and hey, there is the potential for further rotation into other sectors and potentially safe havens too. We've seen the US dollar being bid up. It'll be interesting to see how the precious metals react. We all know about the discussion about cryptocurrency. Will it be an effective inflation hedge? Obviously, it's still a very new asset type, so investors are waiting to make those judgments for that. But each of these are going to be fascinating and relevant discussions to be had over this next period. It is important to note as well that it's not as though there's anything wrong with these companies. The underlying fundamentals for many of them have not changed. In fact, many of them are in a much better place than they were 6 or 12 months. What has changed is the investors' willingness to pay. Investors are willing to pay less for these companies because there are alternatives now. Obviously, with rising interest rates and the potential of the discount rates rising, the valuations that they're willing to pay have contracted. And that's just a natural part of the market. They move in cycles, and we were coming from elevated valuations. And so, at the end of the day, who knows what's going to happen? Nobody has a crystal ball. As we know, everything on the markets is just merely a balance of probabilities. It's going to be an interesting time. It's likely that we'll continue to see heightened volatility, but of course, it'll be interesting to see if there are opportunities that start to open up as a result as well. Hope you enjoyed the video. Thank you so much for joining us. Keen to hear all your thoughts, so drop in a comment below as well. And a reminder, I'm not a financial advisor. Nothing we discuss is financial advice. So just that general discussion to be a starting spot for you to do your own research from. Thanks for joining us. Catch you on the next video soon. For now, stay well and happy investing.